For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
All right, 5, count them, 5 things you didn't know about your Roth IRA. We're jumping right into this thing today. Johnny Dean, your podcast host. Welcome, Managing Your Financial Future, here with Professor Rick Plum. As always, certified financial planner professional, accredited wealth management advisor. And as I said last week, and by the way, we had a lot of success with our 5 things you did not know about Social Security last week. You enjoyed that, didn't you, Professor Plum?
I enjoy anything we're talking about.
Yeah, see, there you go. And you didn't have to study. 5 things you didn't know about your Roth IRA. We had a lot of good feedback on it. I wasn't surprised, but it's always nice to hear. It's always good. So I said toward the end of that podcast that maybe we'll do this 5 things you didn't know about such and such a few more times while we have this particular season, as they call it, for the podcast. So we're going to do this again today. 5 things you did not know about your Roth IRA. And I like this stuff because you brought up a 6th one when I showed you these a couple of days ago. You brought up a 6th one. So technically, we've got 5 plus a bonus.
And I'm sure that we'll go off on tangents and come up with 7, 8, 9, or 10 as well.
Yeah, last time we did a 5 things, I asked, I did a summary and I just said, hey, what did we talk about? And it said, well, here are the 5 main ones. And then there were 4 lesser ones. And, oh my gosh, did we really do that many? But the Roth IRA, now this is not a fact you didn't know necessarily, but the Roth IRA has been around now for it was 1998. So
that was the first year you could contribute.
Yeah, so this is like the 27th year of a Roth IRA. It seems like they've been around forever. I can't imagine life without a Roth IRA these days. And as a planning tool, Professor Plum, it's made your life hasn't made it easier,
wonderful.
but it's given you kind of a gift, has it not? The Roth.
Well, they're wonderful. In a lot of ways, they're kind of a gift from Congress, which is kind of surprising. They're except for that income limit, they would be great on the contributions.
Yeah.
But even that, we can get around in some cases with the backdoor Roth and other things.
Mm-hmm.
But it took away the whole idea of the after-tax contribution to a traditional IRA. Prior to the advent of the Roth, people were doing after-tax contributions to traditional IRAs, and it just stunk because then you got to keep track of it forever, ever, and ever, and you can never get them out in lump sum. You always have to do so. I'm not a fan of and I wasn't a fan of the after-tax contribution to the traditional IRA. It was a little less of a problem back before the Roth IRAs because the capital gain rate and the ordinary income rates were the same rates.
Mm-hmm.
We didn't have a preferential treatment rate at that point. We got that a couple of years after Roth came about. But now that especially now that we've got that preferential tax treatment on the dividends and long-term capital gains, after-tax money in a traditional IRA that's staying in a traditional IRA just sucks. I mean, it's not a good thing. And a lot of people will end up paying tax on those distributions of after-tax money because they've lost track or they passed it on to a spouse or an heir that has no idea that was after-tax money,
Mm-hmm.
and then they're paying tax twice on it. That just, to me, I don't like paying tax once, let alone twice.
Well, and this is one of the reasons
advent of the Roth really helped out.
This is one of the reasons that we like the Roth so much, is that tax-free aspect. And there are other things too. Now, you got to follow the rules, of course, but we're going to give you, I think these are all really good things. I mean, I'm not going to give you anything bad, I don't think, about a Roth, because I really can't think of too many bad things.
I was going to say, there's not much bad about them.
No, unless you decide, well, I'm paying tax now. I don't like paying tax now. I'm in a high tax bracket.
And I had that question from somebody the other day. Why am I doing the traditional 401k rather than the Roth 401k? Similar question to a traditional IRA with a deduction and a Roth non-deductible, obviously. And the reason was that they were getting a late start. They're already in their late 60s, early 70s. They're still working, but they don't have a big nest egg. They don't have a nest egg. They're building their nest egg now. So the traditional IRA, when they ultimately do retire in a couple of years, is not going to be gazillions of dollars. It's going to be $250,000, which is a nice number, but that's only going to distribute 15 $18,000 a year, maybe, couple that with their Social Security, they're still not going to be paying taxes. So they're going to get close to a tax-free distribution from a traditional tax-deductible event today. Okay, in that case, the deduction today is worth more than the tax-free later.
But it is.
For most people that are out there, especially younger people who are starting out, the tax-free later and the flexibility of the Roth, which we'll talk about in a little bit, is a very compelling argument for that Roth IRA.
Oh, I know it. And be nice to have those higher limits, as you said. But let's get to these. Let's get to these 5 things. The first one is that you can contribute after age 70 and a half. There's no age limit on contributions. There's only one caveat with that, which is true of any IRA. Professor Plum, comment on that, if you would, please.
Well, there's no age limit for contributions. There never have been with Roths. That was a nice thing about them. But you do have to be eligible to contribute. Age is just not a factor for determining whether you're eligible. How are you eligible? You have to be working. You have to have a job, or you have to create some form of earned income, or be married to somebody with earned income and file a joint tax return. So you don't necessarily have to be working. So if you're 72, 73, 74 years of age, and you're no longer working, but you're married to somebody, maybe they're 10 years younger, they're only 65, 62, 63, 64, and they are working, and you file a joint return, yes, you can still do a spousal Roth IRA contribution. Now, we're talking about contributions, and unfortunately, people get this confused a lot. We see a lot of retirees that get out into the retirement where they're both retired or they're a single person retired, and we talk about conversions, and they say, well, I can't do it, I can't convert because I'm not working anymore. No, conversions are different than contributions. Contributions require current earnings and are limited to $7,000 or $8,000 a year. Conversions have no age limit other than you cannot convert something that was a required minimum distribution from another plan.
So that's one thing you didn't know about your Roth IRA, and I'm only making assumptions here. Maybe you did know, but let's just say that's one thing you probably didn't know about your Roth. Here's another thing you didn't know about your Roth IRA. Your contributions are always accessible, tax-free and penalty-free. And I know you have kind of an addendum to that as well, Professor Plum, but talk about that.
Right, that's one of the huge benefits, but also can be a detriment to a Roth IRA. Whatever I have contributed, I can take back at any time for any reason. I don't have to make up an excuse. I don't have to tell anybody, I don't tell the IRS why I'm taking the money out. It's not a hardship. It's just, I want my money back. And you're allowed to do that. Now, you do have to file a tax return or your tax form with your return telling the IRS that not why you're taking out, but that you are taking out your contributions, your cumulative contributions. Now, for a lot of people that have been doing this for 28 years, they've lost track of what their contributions are. They don't know exactly how much they put in because the limits were a lot less way back then. You can't just say, well, the limit's $7,000 now for somebody under the age of 50. So I did 7,000 times 28. We've got 200,000, $198,000 in there. No, the limits were a lot less 28 years ago. They were $2,000 at that time. So you'd have to go back and try to figure it out if you're trying to play that game. But if you've kept track of it and you know what they are, you can take it out. And the caveat that John was talking about is a lot of people don't want to save into retirement accounts until they have built up some emergency money in their own name, some money they can get to if in case the washer and dryer breaks down, the car has a problem. Pick your emergency du jour. There's all kinds of life things happen that require a quick infusion of cash, and having an emergency fund can really make stress go down a little bit. It's like you don't want to do it, but if you have the cash, it's a lot easier to do than I have to do it and I don't have the cash. That becomes stressful. So people don't want to start doing traditional IRAs, Roth IRAs, 401ks, things like that until they have saved up some money on the side as an emergency fund.
With something they can access. Yeah.
Well, the Roth IRA can be that emergency fund. You can get the money started in the Roth IRA, and then any earnings that you earn are tax-free going forward in the future. But if you have that unfortunate emergency, you can pull the money back out without the earnings for any reason, So they can be your emergency fund until you get more stable, and you can build up both. Now you're maxing out the Roth IRA, and you can save a little bit more. So you build up some savings on the outside, and you can take the money that was kind of considered your emergency fund in the Roth IRA and get it invested. But it's at least in the Roth IRA at this point, and because you can't do makeup. You can't go back and say, well, I really wanted to do it starting when I was 21, but I didn't get the money in there then, and so I'm going to go back and make that up. It doesn't work that way. But this way allows, and it also starts the 5-year clock ticking on other issues like a first-time home purchase and other things. Mm-hmm. So I think we're hoping we don't have to use the emergency fund in the first place. I like putting the money in the Roth because it is still accessible. It can be a true emergency fund, but it also builds a little bit of a wall between us and that money. If it's just sitting in a separate savings account, that wall isn't quite as tall, and the definition of emergency may be a much tamer definition.
It's fluid, is what it is.
Whereas if it's in the Roth, that wall to get across to say what is an emergency may be a little bigger. So for younger people, I like it that way because it just builds more different, movement or more obstruction between me and it. But it's truly no obstruction. I can get it.
So the benefit that we're talking about is that it's always accessible. But of course, you yes. kind of said that. That could be, I suppose, a negative too, meaning that, I can always get to this money. I'm going to grab it for something that's not an emergency. So
for people that are disciplined, the fact that you can get to the money is not an issue. For people that are undisciplined, they get to it because the credit card got a little bit big last month because they went out to eat too many times, or what, I don't know what the case may be. Not from emergencies, just from the lifestyle being. Yeah. My income isn't supporting my lifestyle the way I want it to. So I'm basically going to rob Peter to pay Paul. I'm going to pull it out of my Roth IRA, rob my retirement to pay for today. Yeah. And so unfortunately, if you're not disciplined, you could screw up tomorrow by trying to live too much today.
But it's still a good thing. And so
it's a great thing.
Accessible contributions, unlike with the traditionals. Okay, so those are two. Let's get to the third thing you didn't know or may not have known about your Roth IRA. And that is that there are no required minimum distributions for the original owner. Kind of alluded to this. I think it was on the air. Maybe not, but no RMDs for the original owner, Professor Plum.
No required minimum distribution. No penalties for missing it. No stress for wondering when it's going to happen. Is it 70 and a half, 72, 73, 75? Are they going to make it different in the future? What's going on? How much do I have to take? Oh my gosh, this is just a big pain. With a Roth IRA, you don't have to worry about required minimum distributions. Now, that doesn't mean you don't want to take money from time to time, because it is a great source of tax-free income in retirement. But there's no requirement that you take any money out. And because there's no requirement, it can be a pretty good legacy asset for a surviving spouse. I really like using it as the legacy asset for the surviving spouse, because typically when you have a married couple, tax bracket is X. When one of them passes away, and now we have a surviving spouse, there's a survivor issue, their taxes basically double. So their expenses go up, and they lose some of the Social Security, maybe some of pension money. And so their income goes down and their expenses go up. That is not a fun situation to be in. But having Roth money at that point can help alleviate some of that pain, because now I can take distributions that are tax-free to help me meet my surviving needs, and cut down on some of that expense.
Yeah, I want to emphasize something you said too, which was, it doesn't mean that we don't want to tap into the Roth from time to time, because when you do things like blending your buckets, when you do things, asset location, all that stuff, it can be used strategically. Unlike with, say, a 401k or a traditional IRA, where
which has a required minimum distribution that is going to be taxable.
Yeah, it's going to be there whether you want it or not, and that creates some extra planning issues, things that you have to get around, a couple of barriers there. So,
I was talking with some people just the other day, and they have different ideas about their RMDs. Married couple, she's been using her RMD under the QCD. She's been giving it away. He's taking his RMD and he's not giving it away. He wants to play with it. He wants toys. I like this guy.
Your kind of guy. Yeah.
Yeah. Now he's a little bit older and he's a guy. So the odds are that she will be the survivor at some point. and we were talking about conversions and other things. And she's like, well, if I inherit it, I'm just going to give it away anyway. So it's not going to be a bigger tax burden on me, when I retire, because I'm just going to use the RMD to give it away through a QCD. So the idea of doing a conversion now and trying to save taxes in the future didn't hold water because there weren't going to be any.
And there you go. Here we are. This is getting to know people and understanding what their goals are. Different goals require a different kind of strategy. And so you have a married couple in that case with different ideas of what to do with their current money. And depending on who goes first, it creates planning opportunities. So, but the idea of not having a required minimum distribution for the original owner is good. Now,
a lot more flexibility.
It is. Now, the heirs, non-spouse heirs, just as a side note, do have a required minimum distribution of sorts.
Right. Now, the heirs for a beneficial heir to a Roth IRA, a non-spouse, as you mentioned, has always had a required minimum distribution from a Roth IRA. The beneficiary Roth IRAs did not escape required minimum distributions. You can't just live and sit there and grow forever and ever and ever and ever. But they've changed. It used to be the rules were the same for the Roth IRA as they were for a traditional IRA, where if the person, they had to start taking money out over their lifetime. Now, we just have a nice, flat, straight 10-year rule. It doesn't matter whether the owner was age 80 or 60 or whatever age, because they never had a required beginning date for their RMDs. There is no requirement, unlike a traditional IRA, where in many cases we have a required minimum distribution as a beneficiary in years 1 through 9, and then 100% what's left over has to come out in year 10. With a Roth IRA, 100% in year 10. So assuming we can afford to leave it alone, if I inherit a Roth IRA, I'm going to try to leave it alone for as long as possible, the 10 years in this case, so that I get as large of a tax-free benefit as I possibly can. Now, I will have to take it out at the end of 10 years, but let's say I inherit $100,000. Is anybody listening up there, please? Hello? No,
a fat chance of that,
it's not going to
Professor
happen. But if I inherit and I take it out now, I get $100,000 tax-free. But if I can afford to leave it alone and I inherit $100,000 today and I leave it alone for 10 years at 7%, rule of 72, that tells me that $100,000 will double. And now I get $200,000 tax-free.
Mm-hmm.
I like tax-free. And so building it into the planning process, I look at ways to potentially do that. Now, not everybody can afford to leave it sit there for 10 years. They may need the money now.
And that's possible. And it's one of the nice things about, but either way, you don't have a required minimum distribution.
So the first 9 years for the beneficiary.
Yeah. I mean for the owner. Yeah. Okay. Well, with the first three things you didn't know, just to recap, you can contribute after age 70 and a half. You can contribute at age 95 and a half. If you want, doesn't matter as long as you've got
qualify for the contribution.
As long as you've got earned income of some kind, where you're paying, I guess it was FICA taxes. How do they count that?
Not exactly that, but generally, yeah. If you're paying FICA or self-employment tax, those are earned in those are earnings. Yes.
Yeah.
But there are some people that work in jobs that they don't pay FICA because they're covered by other plans, and so that still counts. But like rental income, pension income, IRA distributions, that's not currently earned income. That's deferred income that's coming out now. Capital gains, investment income, interest, dividends, those don't count as supporting a Roth IRA contribution.
Right. So, but you can contribute after age 70, assuming you qualify. That's number one.
You have earned income.
Number two, your contributions are always accessible, tax and penalty free. That is pretty straightforward. The third one we talked about.
Just keep track of what your basis is, and you'll be fine.
Mm-hmm. Yeah, well, that's true. Have your advisor do that. That's helpful. And the third thing is that no required minimum distributions for the original owner. So those are 3 of the 5. Let's get to the fourth one now. Fourth thing you may not have known about your Roth IRA is that you can still get in via the Roth 2-step. You did kind of mention that before, but it's called a backdoor Roth 2-step, whatever you want to call it. If you do not qualify, and there are income limitations, Professor, to being able to contribute to a Roth IRA.
There are income limits to contribute to a Roth IRA. Now you put me on the spot, like 236, I can't remember this year.
It's
but
fine.
If you were a married couple making $500,000, you cannot contribute directly to a Roth IRA. And for years, we had this idea once they put once they kept the limit on the income, but they took the limit off the conversion. When Roth IRAs were first created, you could not do a conversion if your adjusted gross income was over $100,000 before the conversion. So a lot of people just couldn't convert. The higher income people couldn't convert. And it wasn't until later, 2010 maybe, that they took the limits off and said, you know what? We're not raising enough tax revenue, so we're going to take the limit off of the conversions. We're going to let anybody convert anybody at any tax level. And then we got this idea. When they took the limit off the conversions, we thought, well, I'm still limited on my contribution. But let's say I'm in a retirement plan and I cannot make a deductible traditional IRA contribution. So I make a non-deductible traditional IRA contribution. And then because there's no limit on conversions, I immediately convert that money. And assuming I have no other IRAs, 100% of my IRA at this point, my traditional IRA, is from that after-tax money. And I haven't left it in there more than a couple of hours, so it hasn't earned anything. So I can convert it across and there won't be any tax because everything in there is after tax. So we had this idea that we could do these, what we marketingly called backdoor Roths or Roth two-steps. But we always wondered at that time what the IRS thought about it and whether or not they were going to come back and say that it violated some rule that we didn't know about. And luckily, about 2014, 15, 16, maybe it was 2017, I can't remember the exact date, they came out and they basically said, no problem, we're blessing this. You can do this. This is not an issue. And I was like, wow, this is cool. So the backdoor Roth or the Roth two-step, step one, contribute to a traditional IRA. Typically, you're doing a non-deductible contribution to a traditional IRA. Step two, convert that money. Now, this, as I mentioned a little bit ago, only works well if you do not have any other traditional type IRAs in your Social Security number, your tax name. And when I talk about traditional type, that means simple IRAs, SEP IRAs, rollover IRAs, contributory IRAs. You pick it up any way you want to call it. Those types of traditional IRAs all count towards the ability to or inability to do this in a tax efficient manner. But if you don't have any of those IRAs, and decedent IRAs are separate from this. You may have inherited a traditional IRA from somebody other than your spouse, but that's not part of this. It's direct ownership of the IRA. If I don't have any others, backdoor Roths, I know people, and the interesting thing, they always keep trying to stick it to the rich, and say the rich aren't doing their fair, the rich have too many advantages. This is purely an advantage to the higher income. By definition, you can't really do a backdoor Roth if you're making less than the income threshold because you can contribute directly to the Roth at that point. You don't need to do a backdoor Roth. It's only available if you're making more than 240, 250, whatever the number is as a married couple.
It almost negates the reason for having an income limit. An income limit. I mean, I get why you should have the income limit, I suppose, but I mean, the fact that you can do this Roth two-step kind of negates that. And we have a whole other. If you know where to look on our website, you can find entire discussions on the whole Roth two-step. So we're not going to get too much into the details on that, but you described it well, Professor. It looks like you're looking up the income limitations for because you had to know
236. It's phased out. Your ability to contribute directly to a Roth IRA as a married couple filing a joint return is phased out if you make less than $236,000, no problem. If you make more than $236,000, you lose the ability on a pro rata scale over $10,000 to $246,000. If you make more than $246,000, no contribution.
Again,
no contribution for you.
Again, that's married couple. Single is not half; it's a little more than half. It's more than that, but just
it's 150.
I don't know.
But instead of a phase out over 10,000, it's a phase out over 15,000. Why? Who knows?
I don't know. But we're not gonna rock the boat because we got the Roth and we got the blessing on the conversions from the IRS. So it took them 50.
For most things, we like the Roth.
It took them.
We love it.
It took them 17 or so years to try to find a way to not do the conversions. But anyway, all right. So that's it. You can get in via the Roth two-step. That's number 4. The fifth thing here, before we run out of time, that you didn't know about your Roth IRA is that Roth IRAs can be great for your heirs. We touched on this, but the rules changed. Actually, you did kind of explain this, so I'm not going to
jump the gun on this. Roth IRAs for beneficiaries have a very simple 0% required minimum distribution years 1 through 9 from the date of death, and 100% by the end of the 10th year of the end of the 10th year of anniversary, 10th anniversary of death. So if somebody dies this year, we'll call it 2025, depends on when you're listening to this, I know. And you inherit a Roth IRA, you do not have to take a dime out of that until 2035. December 31st, 2035, all the money's got to be out of the Roth IRA, the decedent Roth IRA. But you can take anything you want.
Yeah.
Remember, we're talking about required minimums.
Yes.
You don't have to take a dime, but in 2035, whatever's there. And like I said before, I like the idea of, if possible, if you can afford to, leave it alone as long as possible to get the biggest bang for your buck.
It's important to do that. Anytime you can get tax-free earnings, take advantage of it. So since that fifth one we covered, let's go.
If you die during the 10 years and you leave it to somebody else, they don't get another 10 years from your date of death.
No, it's based
till 2035,
based on the original
in
owner.
that example.
Yeah. Somebody thought of that and they threw that in. All right, so let's get to the bonus one then. This is kind of a sixth thing you didn't know about your Roth IRA, and the reason I'm going to put it as a bonus is because I forgot about this until you told me when I sent these over to you. The bonus is, well, the bonus has to do with old 529 plans. Now, under the Secure 2.0 Act, you can roll over unused funds from, I believe, from an old 529 plan to a Roth. But, right. Go ahead.
Yeah. If you have a 529 education account that is at least 15 years old, the beneficiary of that account can use it on a tax-free basis to fund their Roth IRA, assuming they qualify to put money into a Roth IRA. So typically a beneficiary is going to be a younger person because you were saving it for their education, and maybe they didn't need as much. They didn't go to as expensive a school. They got scholarships, whatever the reason may be, that there's money left over. You can use up to $35,000 of that 529 plan to fund a Roth IRA for that beneficiary. Now, you can't do it in lump sum. It is going to be the annual contribution. So in today's world, you can take $7,000 out this year and put it in the Roth. So the person may be starting their career and they don't have a whole lot of money to save and get started on their Roth or anything of that nature. This is a way to get them jump started on it. So over the next 5 years, they can put $7,000 a year, $35,000 total, from their 529 into the Roth IRA. Again, assuming they have earned income, assuming they otherwise qualify to put money into a Roth IRA, you can use the 529. Now, what we don't know about this yet, and what the IRS has not qualified yet, is the 15 years the age of the 529 plan, or is the 15 years since that beneficiary has been the beneficiary of that 529 plan? Can I then have had the plan for 15 years? The child didn't necessarily need it. Maybe we had a falling out. Can I change it, the beneficiary, back to me? Now, I can do that legally. I can change it to me. And if I'm otherwise eligible to contribute to Roth, can I use it to fund my Roth? Or does the fact that I changed the beneficiary within the last 15 years put a new time clock on it? That we don't know.
Well, this is, it's probably not, there probably aren't a lot of people who are going to use this particular.
Well, I know a lot of people that have some, maybe not $35,000, but some people have some money left over in their 529 plans,
and you can put it into the into the Roth. Does this become then a contributory is this a
contribution?
It's not considered a conversion, even though you're taking money from a different. No,
it counts as your annual contribution. So if you've already contributed $2,000 to your Roth IRA, you can take another $5,000 out of the 529. That's 15 years old. You've been a beneficiary for a little time, and put it in and max out your annual contribution. And do that up to the point where you've taken $35,000 out of the 529 to do this. So it's a cumulative $35,000.
Yeah, and that's a good thing. Again, we go back to the whole idea of tax-free being a good thing. So
what else are you going to do with that 529 money? I mean, if you've run out of kids to transfer it to, your youngest one's already graduated, you still have $20,000, $30,000, $40,000 in a 529 plan. Maybe because you've had it that long, half of it's still earnings. If you were to take a distribution of it for something other than qualified education, you got taxes, potentially penalties, and it's that's that's expensive.
What
But
did
if I
we
can
used
use
to
it fund
do?
a Roth, that's a great thing.
What did we used to do with that leftover 529 money?
We tried to make sure that there was no leftover. They went to a 5th year of school. They went to another.
Oh, I can't imagine that. I've got $40,000 sitting here, and I got nobody to. Yeah, I know.
For a long time, I cautioned people, but don't overfund the 529 because it's very difficult to deal with what's left over. Now it's like, okay, we don't have to be as exact. We can go over a little bit.
Sometimes things improve, and that's good. So that's it. That's 5. Well, plus 1. These are all good things. They're I could have come up with a couple of bad things, but as we said before, I just can't come up with really anything bad about the Roth IRA. Other than you don't get a tax break now. But if you need the tax break now, you shouldn't be contributing probably to the Roth IRA, just as a point of strategy.
If you get a tax break now, you're not going to get a tax break in the future. Congress just doesn't do that very often.
No, but
don't do that.
I'd love to see further things happen with the Roth. I've always been a big fan of this, as have you, for the reasons you mentioned. So good
and
stuff.
They have expanded the Roth world, and now I don't know if it's most, but a large majority or a large percentage of 401ks offer Roth 401k plans. And that's basically a very similar, although there are differences between Roth IRAs and Roth 401ks, but it's just a lot higher limits on being able to get money into that tax-free world.
Yeah, you and I were talking before we came on about the Roth 401k, and some of the rules have changed over the last couple of years on a Roth 401k. And to me, as I said, I had told you that it's seems to me almost to be a Roth 401k is almost exactly like a Roth IRA.
Very similar.
Now, other than the fact that you've got much higher limits.
It's not as flexible. I can't just take my contribution out while I'm still working with the company whenever I want to. I can't use it for the first time home purchase. So it's not as flexible, but from a retirement planning standpoint, it's in many cases better because the limits are significantly higher and got the match if you want. Now, if you want the match to go into the Roth, this is new. You can have the Roth matching contribution or the matching contribution at work go into the Roth. You just have to elect to pay taxes on that money now.
Yeah, which you may not be used to. Well, you're not used to paying taxes on money going into a 401k at all now. But
typically, the match goes into the traditional 401k side. And just recently, they opened it up. You can elect to have it go to the Roth, but let's say your match is $2,000 for the year. And your income was $100,000, and well, all things else being equal, you're now going to pay tax on 102, not 100, because you got $2,000 of match.
But it's the tax-free growth that you're.
That's wonderful.
That's why you're doing it anyway. So
it's wonderful.
It's marvelous. 5 things you can contribute after age 70 and a half. Contributions are always accessible. No RMDs for the original owner. You can get in with the Roth 2-step. Good for your heirs, changed rules, but it's still good.
Good for the heirs. Great legacy.
Mm-hmm. And the 529 plan, you can take the unused funds and potentially use up to $35,000 of a 529 plan money to get it into a Roth. This is all good stuff, and this is all part of the planning process. We've talked about blending buckets. We've talked about using different sources, having different sources of money available, and the Roth is one of the big ones. You have pre-tax, you have personal money, and you have Roth money. And to have that third source of money really has opened up over the last 27 some odd years. Planning opportunities that, frankly, we didn't have all those years ago. So it's good. You want to talk to your advisor, of course, before you do any of this stuff with a Roth IRA. But if you want to know more about this, if you want to know about your options, and there are many, talk to any of the Lucia Capital Group advisors. Give them a call, 800-644-1150, 800-644-1150. Professor Plum heads up the financial planning department. So, Professor Plum, you are always looking at these things, are you not?
I am looking at a lot of stuff all the time.
Good answer. And that is true. 800-644-1150, the number at Lucia Capital Group. Also go online, find out more information about this stuff, luciacap.com, LUCIACAP.com. You can find information on, we don't have a Roth IRA guide, but we do have a retirement income guide. We have estate planning guides. You can type that into the search bar up at the top, and you'll be able to access that, read it, and for free, as a matter of fact. I should just say, we mentioned, I think last week when we were talking about Social Security, the guide, it's being updated right now. Is that right? I know it's in the process. So. I know you went through the whole guide and made it finally. The information was still good.
But I mean, we still had the WEP and the GPO in there. We had to get rid of that.
So it made it a little shorter, but anyway. So you can also get the Social Security guide there at luciacap.com. And know that I would guess by the time this podcast airs, it'll all be updated. So that's good. Let's see. Subscribe to this podcast. I should tell people that more often. Love to watch that subscriber count go up. Help us out there. Go to Apple Podcasts and Spotify and subscribe to the podcast and get it downloaded every single week, and you will not miss an episode. Don't want to miss an episode at all. That's it for us. Professor Plum, I thank you so much. I'll let you get back to work.
Well, thank you, sir. I appreciate letting me get back to work.
All right. And you appreciate being on the show. I know you do enjoy this. We have fun on this podcast.
Silly me.
For Professor Rick Plum, certified financial planner professional and accredited wealth management advisor, I am your podcast host, Johnny Dean. Thanks for tuning in. It's Managing Your Financial Future. Talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time without notice. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Distributions of principal from a Roth 401k are tax-free. However, any earnings will be taxed at ordinary income rates. Your investment options are limited with a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. Earnings from a 529 college savings plan can grow tax-deferred and may be withdrawn free of federal taxes when used for qualified educational purposes. Non-qualified withdrawals are subject to a 10% penalty tax. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.